Baidu in the Chinese section now. So Baidu is also listed on, I believe, the Southern Nasdaq or the NYSE, but it's listed in the on the American stock market. So Baidu, in a nutshell, is basically the alphabet of China. Offers more or less the same services alphabet offers. It's in search, it's in AI, as well as in cloud as well. And Alphabet is also operates in the same um, lines as well. So very very good. So yeah, the alphabet of China in a nutshell. All right, let's get to it. The analysis itself. All right, Baidu performance. Now, oh yeah, no, this is not the. Anyway, let's get to it. It's not very impressive. I mean, massive deterioration from 2018 to 2020. I mean, a horror show in 2019 where you have negative margin. That basically means the company, Baidu, lost money in 2019. It actually had a net loss in 2019. Massive bounce back in 2020. Very impressive, very comforting. Um, but I mean, Baidu has been in existence for quite some time. It's the alphabet of China. This should not be happening. And there are reasons for that, and we're gonna get to the deterioration, why it happened, step for step, as well as the improvement as well. So now mainly we can see, cost of revenue has increased significantly. It decreased. Now that is very good because that shows me that the company was probably saying to itself, we're spending way too much and these costs are not justified. So let's bring them back. Let's reel them in a bit. Um, so that is bad, but so that is bad considering it didn't justify growth in the form of net income or growth in revenue. You can see net income decreased in 2019 by 101%. Revenue only grew by a minuscule 4%, and leading together with the cost of revenue growing at a compound rate of 20% in 2019, really led you to have a negative 0.3% margin. R&D growth, growing consistently, not that bad. It's been pretty consistent, slight decrease, 2 basis points, a lot, but it again shows me the entity probably saw here was spending way too much than we need to, not justifying the spending that we do, not justifying growth in the top as well as bottom line. Not really that in our margins. Sales and marketing stable at 10%. That is much expected. When companies tend to cut back on costs, the main thing they tend to cut first to be sales and marketing. So that I expect. R&D as a percentage, pretty fairly stable. Most of these companies keep them stable, so pretty stable. That's okay. Now, 2019, we've seen revenue growth did not justify the growth in costs as well as the expenditure in costs. And we've seen a reaction from that in the form of decreasing certain costs that the entity, in my view, deemed excessive. And that thankfully has led to a recovery and a rebounding of the net margin. Revenue still increased, but pretty minuscule. Net income did increase. Very, very huge, a very, very, very huge increase. So in 2021, 2020 tells me is that the entity basically reined in costs. It stopped spending for the sake of spending. It grew revenue, even though very, very low, it still grew it enough to rebound net margins as well as increase the net income in total. In total. Now, the other reason for for this really really bad performance is that Baidu is a Chinese tech. It operates mainly all of its income comes from the China. Now, unlike your Alphabet and Meta, who have the luxury of being able to operate outside, even though the US still accounts for a large part of its revenue, it still operates all over the world except China. But there's about over 7 billion people in the world. 1.4 billion of those are in China, so we can say what 5.6, 5.7 ish billion people Alphabet and Meta have access to. Well, all the other Western tech companies they have access to it. Baidu basically only has access to 1.4 billion. 1.4 is a lot, but it's still just 1.4. I mean, it's a finite amount of people, a finite amount of eyeballs, a finite amount of hours. Now, so it does have market risk in the form that it's overly too exposed to one market. It does have product risk in the form of it only offers mainly one product dominates revenue, which is search and ad-based revenue and ad-based revenue services. So when you have in China the fact that in China we have seen an explosion of other social media companies, ad-based companies, and these companies have been the competitors of Baidu. They have been eating into Baidu's margins, their market share as well. And because they're only limited to one market, they are disproportionately affected by market risk. You can see the fact of a slowdown in revenue as well as minuscule increases in revenue. So that is a bit of a warning in my view, because yeah, you can control costs, which is very good, and you can stabilize them. But there's a point where if you start spending less below that point, you're basically losing pace with the big boys. So Baidu's financial performance, the picture it paints between 2018 to 2020, is one of a reactive measure to adverse market effects. So it's not one of growth story, it's one of reacting to competitors, reacting to the disproportionate risks it faces, product and market risk. Now, from a profitability point of view, it is profitable. But the question is, how much of this profit can it sustain? How much of this profit? How much of this profit can it sustain, and how much of it can it grow? So, and we have seen a struggle to protect its market share because other big boys in China are eating into its revenues, into its margins. So, from a profitability point of view, yeah, it's recovered, but the recovery it's more reactive, as well as we need to keep a close eye on competitions. Furthermore, on top of the market risk, on top of the product risk, is regulatory risk. Now, bear in mind, Meta and Alphabet also faces these risks, and I don't talk too much about them, but because they've been diversifying. So, for product risk, Meta it's been diversifying into the fact that it's now offering a streaming. It has gaming platform to allow gamers onto its platform. Commerce, allowing influencers to sell products to their users, to their followers on its platform. You've got the Meta arm of the company and the metaverse arm of the company, and you can't see it, but I'm metaverse. I'm putting in air quotes because just a quick side note. I'm getting a bit distracted, but I'm of the view that companies are now using this. I don't believe Meta is, but other companies are using the whole word metaverse to basically jack up their share price. But anyway, and saying we're a meta company or a metaverse company just to jack up their share price and get artificial excitement around their share price. But so Meta has been diversifying. It's offering a range, hardware services, in augmented reality and virtual reality headsets, commerce, gaming, streaming. It's offering more. Alphabet, it's in cloud. You've got the operating software, the Android software. You've got business enterprise offerings. You've got Google apps for businesses now. You've got cloud business. You've got consumer electronics as well. So they're diversified. Their product risk, their market risk, they are expanding heavily into other markets, excluding China. So they've got 5.67 other billion people to play around with. So they're diversifying to that. Where Baidu, it has a that the product risk, market risk has a disproportionate effect on its operations. So that worries me. But yes, it gives me access to China. But in this case, where risk is increasing, how can the company promise profitability? How can it promise prosperity? It's a good sign that it has rebounded, but it's more reactive than, in my view, growing. It's more reactive because a lot of it comes from slashing prices. Because revenue still grew at 6%. That is good, but it's mediocre at best. Still grew at that. So what the revenue growth, what the slashing in cost, yes, good cost control. But what they're telling me is you're spending way that you should have spent, as well as you're decreasing costs to react to the fact that the other companies, the big boys, are eating into your margin because your revenue is only increasing at 6%. So it's more reactive than, I would say, an indicator of prosperity. Regulatory risk. Chinese companies are under a barrage. They are under a snowstorm of regulatory um, setbacks, and their share prices, you will see, has indicated that. So that will also eat a bit into profitability because companies might not grow at the rate they want to grow because regulatory risk basically just clip their wings and forces them to be in a box that the regulators want them to be in. So that is also scary, and that is also, in my view, weighing a bit. And that, in my view, should also weigh a bit on investors' minds when you are investing it, because we're going to see the true effect of the big picture of the regulatory risk in 2021 financial statements, which are not out yet, will probably only be out in February of 2022. So profitability, it's a bit of a no for me. It is profitable, it's grown, but it shows that it's growth in profitability, stabilization of margins, growth in margins. It's more of a reaction rather than an indicator of profitability. And you have to consider the fact that market risk, product risk, and regulatory risk having a huge effect and are weighing this company down. So you need to consider all of that before you put your money into this. And that also kind of shows you that profitability in the near term, so after 2021 onwards, it might be a bit difficult. Right? It might be a bit difficult. So profitability for me, it's a bit of a no. Return on equity. Boy, bit lackluster. Well, not bit, very, very lackluster. The return on equity, ability of Baidu to turn shareholder capital into returns, very, very inefficient. It has outperformed the S&P 500 for 2018 and 2020. Those were the 3 years. 2 of the 3 years, it only outperformed the S&P in 2018. 2019 it underperformed, 2020 underperformed, and in average it's also underperformed. The S&P returned 13%, Baidu on average 29%. So it's not been very efficient in utilizing shareholder capital in providing returns. So again, that also shows you from a profitability point of view, the company is not very efficient. Very, 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 very worrying. Current ratio, not the balance sheet of Baidu, even though its profitability is worrying me, should still be good. Should still be good. Should still be very, very, very good. Because remember, asset light, cash heavy industry. So what I see is a good current ratio driven mainly by the heaps and stacks of cash on the balance sheet. Very good. On average is 2.7. 2020 it's about 2.7 as well. So about 2.8, 2.7. So 2020 is 2.7, average is about 2.8, so still very good, So for each short-term current liability on its books, it has two liquid short-term current assets to cover said liability. So very good. It shows it's in a good liquid position. Balance sheet's in a good liquid position. Bit smaller than was this Alphabet and Meta, but you look at revenues, they're not that much. What is it, 16,000 in 2020? So that will be at a million. That will be 16 billion. So it's very small, considering Meta's revenues are about 86 billion in 2020. Alphabet's revenue in 2020 is about 186 billion. So it's still very, very small compared to the big ones. Still very, very, very small compared to the big boys. So you need to always consider that when you want to compare the current ratio of Baidu to that of Meta and Alphabet, but it's still very, very good. What I would expect is that, like Alphabet and Meta, I expect it to have cash flow, which it does, and I would expect that cash to drive the balance sheet to be in a very solid position, which it does. From a liquidity point of view, this is good. This is very, very good. Above 2, it's very good. Showing the company is very liquid, driven mainly by the stacks of cash it has on hand. Debt to equity. Okay. A lot, but debt to equity, so for each dollar of net worth Baidu is worth, it only holds 77 cents in debt. Again, considering on average a good ratio would be 1 to 1. In this industry you'd expect it to be 1 to 1 because it's so cash heavy. But the fact that it's so cash heavy and it's still borrowing so much money, you can read it with the fact that competitors are eating into its margins and eating it into its market share. So it is borrowing quite a lot to be able to compete with the competitors. So yeah, I can live with it. I can live with an increase in the debt to equity ratio as long as it's effective and productive. But it isn't, because you look at the debt to return or the risk to return relationship, Baidu on average has a debt to equity of 77%. In 2020 it has 77%, but it's only returning on average 9%. In 2020, 13%. So shareholders are taking on a lot more risk at a pretty minuscule return. So that worries me a bit. The fact that the debt to equity is quite high, but returns are still substandard. Margins are good, but that's more reactive and due to cost control. Revenue is very lackluster, very, very mediocre. So again, still good. The balance sheet is still good, but are you using this balance sheet efficiently enough to realize returns? No. So good balance sheet. It's fantastic. It's still good. It's not as good as in Alphabet and Meta, but it's still good. It still has, for each dollar of net worth, we hold 77% in debt. So it's still good, but not efficient use of the balance sheet in my view. So balance sheet very good, but not happy with how it's being used to return capital and to provide returns and to grow the company. Cash margin, so at liquidity. So okay, I know I talk about liquidity in the balance sheet and the liquidity again in can it turn operations into cash. So liquidity it does mean two things. You've got liquidity in the balance sheet, and then you've got liquidity again in terms of cash generation. All right. So now we're talking about liquidity in cash generation. Can it generate cash? So is it a liquid company? Can it generate cash from its operations liquid? So you got the balance sheet liquid, it's the operations liquid. Yeah, boy. Yeah, boy. Somebody look at this donkey's breakfast. Not good. It's been declining. Um, not good at all. So from 2018 to 2020, the cash from operations margin, so the net cash from operating activities margin, two terms mean the same thing. I just use cash from operations margin because it's much shorter and you can't see it. I mean, it's just much shorter and less of a tongue twister. Net cash from operating activities a bit longer and a bit of a tongue twister, but two things they mean the same thing. The margins have declined dramatically. They have depreciated from 35% in 2018 to 23% in 2020, average of 28%. But they have really declined. I mean, this is really bad. So number one, it does show me that the company can generate cash from its operations. So for each dollar of revenue it has, it still generates about 23 cents or 23% into cash. Very good, because it can turn operations to cash. What is very bad is the depreciation, the decline, the deterioration, the absolute donkey's breakfast. That is bad. We went from 35% to 23%. That is very bad. It is worrying as an investor because it tells me that your margins are decreasing. Why are margins decreasing? Why is your operations decreasing? Why are you generating less and less cash? That means your business model is unsustainable. Your business model is not productive. It's not geared towards long-term prosperity. All right. You're borrowing a lot. Your borrowing base is relatively high, but your margins are still decreasing. So, I mean, if you're borrowing kind of a lot, you have sufficient cash. So, you have enough cash resources to basically stabilize your margins, protect your your market share, and grow your market share and diversify into other businesses to reduce product risk. So you have enough cash to do that, but your margin is still decreasing. So that to me as an investor is worrying. It is very worrying. The sheer unproductiveness of using cash resources, the balance sheet, to safeguard, rescue, protect, maintain your margins, that to me is a bit worrying. And that to me tells me that market risk and the fact that competitors are eating into your margins and product risk is having a bigger effect on Baidu's operations than previously thought. Out of that, yeah, there was a slight deterioration, but it was slight. However, they still had a good balance sheet. They weren't borrowing anymore, and they still had significant cash on hand. Significant cash on hand. So this is worrying to me. But a bit worrying. Well, not a bit. It's very worrying to me. As an investor, this is very risky to me. I'm taking on a lot of risk for subpar, lackluster returns, reactive uh, financial performance compounded by really minuscule revenue growth. Yeah, you grew the net income over 7,000%, but that was more reactive than anything because you just decreased costs. And on top of that, you're giving me substandard decreasing cash flow margin. That is bad. And things are made a bit worse by the fact that the company does not have a sufficient cash flow on hand. It's below one. So, but again, that can be explained by the fact that your margins have been declining. So I mean, if you have less and less, if you're making less and less and less cash from your operations, which Baidu is, you're gonna have less and less and less cash um, to fund operations. And that's if you have less and less cash to fund operations, that's gonna mean you have to borrow more. So again, that explains the increase or why the borrowing base or the debt to equity is so high with Baidu. It's making less cash, meaning it has inefficient or not enough, not sufficient cash to fund operations, and it has to borrow more to close that gap. Again, that to me is a bit worrying. It does provide returns, but I mean, again, I'm of the view that why you paying 54% of your net cash from operating activities in the form of a buyback when you could pay less, or less than half of that, well, about 40% of that, well, less than 40% of that. You can pay less than 40% and use the return and use the rest to bolster your sufficiency of cash flow and reduce your financial risk. And reduce your financial risk. Reduce your financial risk. I mean, so that's the question. That is the question. You have to understand that this high debt itself will eat into money in the form of interest expense. That's kind of yeah, it was kind of difficult to determine values into expense because they netted off with interest income. The balance sheet struggled. I spent a lot of time trying to look for it, but yeah, struggled with it. Um, but either way, going back to the main point, you know, this means it's too high. I mean, you can spend less, bolster your sufficiency of cash flow, reduce your debt to equity ratio, and bolster the balance sheet by having to borrow less and spending more on interest expense. So yeah, yeah, this is not a very good use of cash in my view. It's not a very good use of cash. I mean, yes, I mean it's good. You're returning a lot of money to shareholders, but this probably looks to me like you're just trying to get a reaction out of the stock than anything. So I mean, not a very efficient use of cash. Could have been used better, but it does pay. What is it? Buybacks to shareholders. So we'll have to compare it to another company to extract more um, meaning from it. See how does it pay relative to other companies. But yeah, I'm not happy with that. Now look, Baidu, I don't think it's going bankrupt. I mean, Baidu's not going back. I don't think it's going back. It doesn't look like it's going back. It's still in a strong financial position with a very solid balance sheet. However, it's not using its resources efficiently enough to grow operations, as well as not using cash flow sufficiently enough to grow the top and bottom line. So not happy with this company. I'm really not happy on all levels. Um, you can see the stock price has just been an absolute wood chipper for shareholder money, destroyed shareholder wealth. But a lot of this, you can see the decline started roughly around about what 2020, 2021, 2021, late 2020, late 2020. And then you can see right about here in April, that's when the crackdown happened. That's when the regulatory crackdown really happened. So, you need to be very careful, in investing in Chinese stocks, especially considering the massive risk that exists because of the regulatory crackdown. but at the same time, it's not been performing as good as I would want it from a financial point of view. But you know, it's still good because look, these Chinese companies are still good because Baidu, in this specific instance, they're very good because they give you exposure to China. However, with that exposure to China now, as we've seen in 2021, comes with a heavy dose of regulatory risk. And that regulatory risk could mean that, for example, companies like Baidu are put in a box and are not allowed to grow as their Western peers might be growing. So yeah, you know, the regulatory risk for me kind of turns me. The regulatory risk, countered with the fact that it's not been that efficient using cash flow and resources, kind of turns me off these companies. They kind of turn me off these companies, the Chinese companies in this view. Um, I have been burned by some, not Baidu, but I have been burned by some Chinese companies, especially at the height of the regulatory crackdown. So, I mean, it's a good company in the sense of you get a feeling that it can just stabilize margins and get some market share and start competing with some of those big boys that are eating into its market share, that it can give you solid returns. But its job has been made a bit harder by the regulatory risk. So as you can see, it's been really knocking. It's been a wealth destroyer. All right, that's Baidu.